Hey guys, welcome to another Trade Genius podcast. I've got my good friend Bob Kudla here. Guys, they say beware the Ides of March. We think it's going to be the Ides of February you need to worry about. Let's dive in.
Trade Genius.
You know, Bob, we've been seeing a lot of warning signs. I don't know how many warning signs I've seen in the last couple of weeks, just long-term warning signs that are saying like, hey, you got to get defensive here over the next, few weeks probably, because the likelihood of us maybe seeing a top in Q1 of 2025 looks extremely high at this point.
Yeah, what's funny is that, the bull market really is really been over since the election. We've just been in this massive trading range, and we get these funky moves, and kudos to you, because everybody thinks we're just a bunch of bears on here, is every time we got a gap down, you jump on the mic first thing and say, guys, don't short this hole, because they keep trying to lift it up. They try to keep lifting it up. And if you look at the chart, we're not going to show it today, but look on the daily SPY, you can see these gap downs and they lift it back up to squeeze the shorts, gap down, squeeze, gap down, squeeze. And what they're doing there is they're wearing out the people who are short, the weak shorts, because they're preparing us for this next chart. And this next chart is basically the top for February is always the middle of the month. And this is a super high correlation, a number of instances this happens. And, this weakness pushes into March too. So if you've been riding high on some of these high beta names, then you may want to pull your chips in a little bit. You may want to throw on some defensive puts if you have them, or sneak into some of these leverage ETFs for the next 3 to 4 weeks. Because I think this is going to really catch people goofy-footed, because now they're training the market to buy the dip, and the baseball bat's coming. And here's another mathematical equation I'm going to let you explain, Phil, that's saying the juice that's been juicing this, I think the coffee bar is empty.
Yeah, options markets often fuel a lot of what happens here, and it comes from deleveraging and things like that. That's why, you look at the CPI reaction today. Well, obviously, big miss. It was hot, right? And that's like the big boogeyman for the markets. But guess what? That's hedged, right? The bad CPI number is hedged. And so when the hedging basically covers everybody's exposure, they can cash in those hedges, and then the market comes off, and all of a sudden the market snaps back. So unless you have something like really materially, markets don't like surprises. So if something changes the market outlook significantly, or is a surprise that they weren't hedged for, that's when you have news creates a move that was unexpected, and then that changes the whole framework of the market, right? So, whenever you get a news event, has an initial bad reaction, and then that bad reaction gets basically bought back up, that's an extremely bullish sign for the next few days. So I think that's what we saw today. Now, will we make a new all-time high? It's possible. I'm just saying we're out of time in the big picture. At this point, we've been saying, hey, you guys, be careful, be careful, be careful. Yellen did what she did with the treasuries and the T-bills to push things out. But, it looks like we're kind of out of runway here. Here's the chart that, when you look at options and all the different flows from options, right? Those second and third order Greeks that go along with it and that push this market around, you got to look at the put call ratio. Now, we're at a level that historically has been very, very bearish. If you look back to the left of the chart, 2018, if you guys remember, end of 2018, we had a really bad spill. It felt like almost like a mini COVID type crash, which then 2019 recovered. But then we saw things happen later in the year that actually led into that COVID crash, reverse repo window open and things like that. Now, you might say, well, in the middle of the chart, your put call ratio dipped under 0.8 quite a bit, and that didn't seem like it affected things. And you would be correct. However, that was when we saw the largest money printing operation in the history of mankind. I mean, we printed trillions of dollars in a small window, more than we ever printed before in history up into that time. We engulfed all of the money printing up into that time. I mean, it's just a massive, massive money printing effort. So yes, under those conditions, put call ratios doesn't mean much. Now, come 2022, they said that's done. We're now going to do QT, meaning they're going to do the reverse of QE, right? We're going to start pulling liquidity out of the system. We get our first dip in those conditions back under minus 0.8. And lo and behold, we're right at the top of a market. And then we pull back in a mini bear market that we had for 2022, right? Which is ultimately like a wave 4 going into now this extended wave 5 that we've been in ever since. So now we're in a QT environment still. And now we have our put call ratio crossing that bearish threshold. So the point here is that the options market is telling us that, outside of a full-on printing environment, which we are not in, the options market is saying that they are gearing up for a pullback, and a significant one at that.
Yeah, and people have to realize that what happens is all this option selling, it's like pushing up the tide high, and then it just overflows the banks, and they have to release it. And the only way they can release it is by lifting VIX again. And so that's what you can expect. Usually twice a year, you get these big moves in VIX. You get it in February, March, and you get it in September and October. The rest of the time, they're call selling and put selling like crazy to drive the markets higher. But it gets to a point where there's nobody is willing to make the bet on the other side, and then the tide rolls out. So we're still in our thing. If you go back a couple of weeks, and we maybe even last week when we talked about how the year is going to unfold, we're still week February, week March, and then Phil has his best shot at an all-time high in April. In fact, we've had in the past, Phil, where April did make a new all-time high before the big sell-off. So that's possible. But then if it doesn't happen in April, it's not going to happen. Then you definitely get into May, June is a continuation of April good guy stuff, and then July, basically through the rest of the year, you have a chance for a big sell-off. I don't know if you can pull the chart up, Phil, but we're definitely vibing the same way 2001 look, where you have a high was made in March, and then it jerked around, for a couple months, and then it just rolled over hard, and then it rolled over for 2 years. So I'll let Phil bring that up, and we can go through that.
Yeah, if you look at this chart here, which is just the a representation of the S&P 500, you'll notice we have our super histogram, right? So this is our kind of like our go-to indicator now. We think it's probably a maturation of everything that we've done in the last few years, me and Bob. So you'll notice where our histogram's trailing off here. Essentially, that's a bearish divergence. Now, this is a weekly chart, and you'll notice that when you get that bearish divergence, that precedes these big drops. Well, guess what? Histogram's dying off. That means the strength of the move is dying off, and we're going to be careful about this. So, we don't really, you're going to get pullbacks, right? Like this blue line here is the 144 on the daily, right? We saw pretty close to that on the index here. We got one back here. Where things get dicey is this pullback gets deeper, and we start seeing things like the weekly 9, which is this maroon line, starts to cross that. Okay, now we got issues. Now, obviously, the market's going to be pulling back deeper than what we see here, but these are the things that have to happen. These crosses have to happen before we can start talking about, okay, we might be going into a bear market. So, obviously, we're not there yet, but this to me, if you want a leading indicator, this is a huge warning sign here on our technicals, right? So then if this starts to roll over in the coming weeks into red, when the histogram starts to go red, now you got issues. Now every time we get a rotation on our trend line back up, those are shorting opportunities like here, right? So it's going to be a much different market. We're going to see a market that is essentially going to be sell the rips. And you can see how even like on the weekly 9 EMA, all of a sudden caps price. Now this was a truncated bear market where we had, again, a pullback. I believe you can call this a wave 4 going into a wave 5, if you're an Elliott waiver. But, instead of trending over these moving averages, right, we're trending under them. And that's something that we need to see that transition, and we haven't seen it yet. But this is a huge warning sign. I would say that we're weeks away from a potential dip. So we have to really watch now. What do you look for, Bob? Well, you look for the lower highs and the lower lows, right? So we got to see some of these weekly lows get taken out, and not just a quick stab. Like we got to start spending time under these areas. And I think that's coming.
Yeah, we have a triangle going right now. It's kind of a weird, some people call it an arrowhead bull flag, kind of environment, so that can potentially break out. But, I think we have till Tuesday, Phil. Then we roll over, from there. And the stock market almanac says post-election for a Republican is the weakest year of the 4 years. So if they're going to pull the plug, which, look, Trump is in no hurry to force the interest rates down. He's not putting any pressure on anybody. He's just mumbling about we should have lower rates. I don't think he cares. I don't think he cares if the stock market takes a hit this year, as long as next year you're basically batting 1,000, right? Going into the next election. And that's typically how they do it. First year after the election is the worst year, and we're really setting up for it. I mean, look, the amount of liquidity they're taking out of the economy right now is no joke. The Fed is not doing anything, the Treasury is not doing anything, and Trump and Elon Musk with the Doji thing, that spending is still spending. And you cut that spending off, even though it's bad spending, you're going to feel the pain of it before you feel the gain of it. And I think that's where we're heading, Phil. So guys, come check us out, tradingatgenius.com. There's some great trades still happening out there. And even when it rolls over, there's going to be some good trades for the bear side. So come check us out. We got specials running. Instead of Valentine's Day for your loved one, show some love to Trade Genius. See you later.
Trade Genius.